QuickBooks Pro Desktop 2021. Fixed asset items, sale of fixed asset. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our fixed asset practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're now going to record the sale of property, plants, and equipment, PP&E, or depreciable assets. Well, let's take a look at this first by opening up the balance sheet. Go into the reports dropdown, company and financial, and take a look at that balance sheet standard. We're going to change the dates up top in the customized reports from 01/01/21 to 12/31/21 and okay. So we're looking down here at our fixed assets. We're going to sell a component of the fixed assets. Now, there's often going to be some problems that we have to address when we sell a fixed asset component. It's usually a little bit more complex. Note, first of all, that we're not selling inventory. It's not like we purchased something with the intention of selling it and then sold it. We still need to track it in a similar way, but if we purchase the inventory, we might use a cost flow kind of assumption, like a FIFO, LIFO average and whatnot. When we use the fixed asset, we purchased it in order to consume in the business, and therefore we allocated the cost to an expense in the form of depreciation, or that's what we would do as we consume it over time. So now when you take the fixed asset off the books, a couple concerns we're going to have. One is that you're going to have a cost component that's going to have to be decreased. So we're going to have to decrease part of the furniture and fixture in our case, and we'll have an accumulated depreciation component considering the fact that we decrease the value for the book value declining over time, or the consumption of the cost over time, in a separate account called accumulated depreciation. Now, we don't have one here yet because it's the first year, so we're going to record this, so we're going to have to deal with the recording of that. That's going to be another issue that we will typically have. Even if we had recorded the accumulated depreciation, say for the last year or even the last month, we may not have fully included all the accumulated depreciation because that is something not typically calculated within the QuickBooks system. We're going to track the accumulated, we're going to track the cost of the equipment in our fixed asset items, but we're typically going to do an adjusting entry at the end of the time period, oftentimes relying on external software such as tax software from our accounting firm or CPA firm or tax preparer firm that will help us to basically give us the adjusting entries for the recording of accumulated depreciation and depreciation expense. Therefore, if we make a sale in the middle of the year, we probably don't have the accumulated depreciation lined up exactly up to that point in time. Also, note that another kind of issue with the depreciable assets is that this amount on the balance sheet represents multiple assets here that we need to then break out into their components. Now, we can do that in part because that's what we've been tracking with our lists. So we can go over to our lists over here, and I can go to my fixed asset item list, and I can say, okay, which thing am I selling here? I happen to be selling a table. So it was one of these tables that we set up, a conference table. I think it was this one. I think we're going to sell that table there. So we might be tracking the cost, and you may not be tracking the cost in this way within the QuickBooks system. This can kind of support the cost side of things, but we don't have a line item here telling us the accumulated depreciation broken out by component. So this schedule is really nice for us to help support us as we provide the information, say, to the accounting firm and to list for tax preparation and to list the item that we are selling, so we can mark it off and say, hey, we're selling this one. But it still doesn't give us all the information we need really to calculate the sale, because we really need that external software typically to do the depreciation calculation for us. So you might, if you work with an accounting firm or something like that, or CPA firm or tax firm, they might then give you software like this. This is Lacert. It's owned by Intuit too, which is the owner of QuickBooks, and the tax could be calculated on a regular federal tax basis, so which is usually accelerated in some way, and then you might have separate book depreciation. So you may be calculating your depreciation just on a tax basis, which means it would be easier, although not perfect for the purposes of recording depreciation, because it's an accelerated method that's not designed for decision making really as much as other things tax related. Or you might have a different depreciation method for books, which is harder because then you have to have a separate depreciation schedule for taxes that, you know, your tax preparer will have to deal with and switch over to or whatever. when you do the tax preparation. So that's going to be something you got to kind of consider. Are you doing your books on a tax basis with regard to the recording of a depreciation, or on a book basis? Notice that this software, I have to put this in, the tax preparer has to put this information line by line into the software. If I was to print these reports out, in other words, it would look something like this. I have to put each one of these line items in to the software so that I can calculate the depreciation per item. And that's why we need this information, this list from the from the QuickBooks in some way, shape, or form. And then we can, once we have this listed out, we can calculate the depreciation, calculate the accumulated depreciation. And then if we sell something, for example, this item, we're saying we're selling the conference table on 11/15, then I need to calculate the depreciation up to that point, which can be a little bit more confusing, because now you got a mid-year calculation that you'll have to do. Now, if you have a straight line method, as we're doing here, not too confusing because it's straight line. But if you're using some accelerated method, like a double declining balance, or if you're using tax depreciation, it can often be more confusing because you'll have a mid-year convention and whatnot. So here, for example, here we're going to say that this was purchased in the same year, 1347. It's unusual to sell it in the same year, but this is just an example. So 1347 divided by 7 years, that would be per year, divided by 12 months, that would be per month, times, it looks like they have 8 months here, times 8 months, that's that 128. So we can kind of calculate it if it's straight line. If it wasn't straight line, it'd be a little bit more confusing. And if it's using tax, it's got a mid-year and a mid-month convention and whatnot, which can make things more confusing oftentimes as well. So to record this then, there's a couple ways we can record this sale. We might say then, I might just want to label it here as having been sold. So one thing we can do for sure is we can double click on this item if we're tracking it in the system. And we could say, hey, we sold this item. Here's the description. The date of the sale we said was on 11/15, I think. I'm going to say the date of the sale is on, I'm going to say 11/15/21. And the sales price we said was $700, no sales expenses. So I want to have that listed because I want to tell the tax preparer at the end of the year that this item was then sold. I'm going to ignore these things, and so there we have it. So then when you create your report, I would then go to the reports over here, and I would say I want to take a look at my fixed asset listing report, and then I would customize the columns so that I can include the date that was sold. So there's a column over here that you can say, all right, I want to see the date that this thing was sold. So sales date, I'll include that and say okay. And so there, now we have the sales date on it. So when I provide this to the tax preparer, they can have it at the end of the year. Now, if I don't get the depreciation as of the point of the sale from the accounting firm, then I might want to do a similar method we talked about before, which is just to say, hey, look, I don't know the depreciation up to the point of sale, so I'm just going to record the money that I got. I'm going to record it on a cash basis, and then I'm going to record this to the CPA firm and let them see it so that they can then plug it into Lacert and calculate, or whatever tax software they use, and calculate the depreciation up to the point of sale. And that way, because if you try to guess what the accumulated depreciation was and you get it wrong, then really that just creates more work anyways, because they're going to have to reverse the sales transaction so that they can then record it with the proper amount of accumulated depreciation, and so it kind of doubles up the work. So if you don't know what the depreciation is, that could be a method you can use to work with the tax preparer. You can just say, hey, look, I recorded it on a cash basis. We received $750. I recorded basically an increase to the $750 and the decrease going to the furniture and fixture account for the $750, which I know doesn't line up to the cost, which you can find here because I don't know what the book value is. So I just recorded it on a cash basis, and I would like you then to make the adjustment for it. Or you can contact the CPA firm and say, give me the depreciation up until this point in time. And if it's on a book basis, you can say, okay, plug this into your tax software to calculate the depreciation up until the date it was sold, 11/15/2020, 2021. We're going to imagine this is 2021. The tax software is not out for that yet, but imagine this is 2021, and say you're going to sell that at 11/15/2021 and give me the depreciation up to that point in time, and then I can properly record the sale with the proper amount of accumulated depreciation recorded. So what we'll have to do then is say, okay, this 128 is depreciation that has not yet been recorded on that piece of equipment. I need to record it and then record the sale having that in place. So let's do that. I'm going to record it, and it's kind of like similar to an adjusting entry, but I just want to record it for that 128 so I can get that in place before I record the sale, so the sale will be recorded properly. So I'm going to go back to QuickBooks. Typically, this is done with a journal entry, these adjusting journal entries, so I'm going to do that. Company drop down, we're going to go to the Make Journal Entry, and then we're going to record this to depreciation. So I'm going to say that we're going to say this is as of, I'm going to say 11/15/1, and then I want to go to depreciation. Now notice I have one depreciation account. I may want to add other accounts to record depreciation per category, such as furniture and fixture. So I'm going to go ahead and do that. I'm going to say add another account. I'm going to call it a depreciation account. I'm going to say continue, and then I want to make it I'll call it depre, and then this is going to be furniture and fixture. So that'll give us a little bit more detail. So I've corrected the spelling here. I'm going to make it a subcategory of that depreciation account. So there's the depreciation account. It's a subcategory. So I'm just going to debit depreciation expense in essence. So there we have that. And that's going to be for the amount for that one line item that we were looking at, which is that 128. So I'll put that in place for the debit of 128. And then this is I'll just not have a note right now. And then I'm going to say accumulated depreciation. So I'm looking for ACC depre for the building now, for the furniture and fixture. ACC depre fixed asset account for the furniture and fixture. Then I'm going to say save and close. I'll make this a little larger so you can see the accounts. So there's the accounts. I'm going to say save and close, and yes, and okay. And so then if I go back to my balance sheet then, balance sheet on the open windows, we now have the accumulated depreciation represented by that negative number. So within the furniture and fixture, we've got the cost and then the accumulated depreciation. We have not yet recorded the sale. The net amount for all furniture and fixture at this point then is that $3,098. Now I didn't record the accumulated depreciation for the other components. I just recorded it for that one line item so that I can then record the sale. On the income statement, if I go to the reports drop down, company and financial, take a look at the profit and loss, changing the dates from 01/01/21 to 12/31/21. We then see that depreciation under the subcategory of depreciation expense for the furniture and fixture. So now we have everything we need to record the sale. Now, if we think about this in journal entries or just increases and decreases in accounts, if I go back to the balance sheet, we know that the fixed asset item is sold. The fixed asset item, if I look on my report here, is we purchased it for the 1347. So that 1347 is included in this 3226, as we can see here. In the 3226, that 1347 is included there. We also have that, and that's where we can see it on our fixed asset item list. So it's included here. That's the item that was sold. So we're going to completely remove that one. So that's going to be a decrease to the asset, or in other words, a credit to the asset. Then we have to decrease the accumulated depreciation related particularly to that asset, which happens to be the full amount here because we haven't recorded any other accumulated depreciation because it's the first year, but that won't always be the case. I'd have to pick it up from the schedule and say, okay, here it is, the 128 for the current year, plus if there was any prior year, there wasn't any because this is the first year. So that 128 is going to have to go off the books. It's a credit. If you think about debits and credits, we're going to debit it. And then the difference between the two is going to be the gain or the loss that we will have. So in other words, if I took a look at this, I'm going to say the book value of that one piece of equipment right now is the 1347 minus the 128. And then we sold it for $700. So minus, I think it was $750 we sold it for, did I say? That's going to be $469. $469 will then be the gain or the loss that we'll have on this transaction. Okay, so that's what we'll do then. Now, cash is going to be affected, so we could then go over here and think about what type of form should we use. You might just use a journal entry to record this transaction. So you might think, okay, I'm going to go to the company, because First of all, there's no form here that records the sale of fixed assets that's designed specifically for the sale of fixed assets. Why? Because we don't sell fixed assets as our normal business process. We sell inventory, but this sales item here and this sales item here is not designed to sell fixed assets. It's designed to sell inventory or services. So because fixed assets is not something that happens all the time, there's no form that's designated basically to that transaction. Usually when that's the case, we would then default to like a journal entry. And if we did the journal entry, I'll just do it. I won't record it, but just take a look at what it would look like. Company drop down, make journal entry. It would be as of 11/15. And we would then say that we got cash. I'm going to say, or checking account would go up with a debit of the 750. And then the other side would be going to the, I would call it the fixed asset, which is the furniture and equipment. That would be going down for the amount of the 1347. So it would be a credit of the 1347. And then we'd have the accumulated depreciation for the furniture and fixture, which would be the 128. We'd have to debit that. That'll make it go down to 0 with a debit, 128, because that's going to be this amount here. And then the difference would be going to gain or loss. Now, I've actually adjusted the checking account here because I think we said before it was 700, not 750. So if it was 700, then we're going to say we sold it, the book value was 1347 minus the 128. That's the book value, 1,219 minus the 700. That's a 519 loss. So now we have a 519 loss. I'm going to record the loss. I'm going to set up an account here. So I'm going to call it loss on sale of fixed assets tab. I'm going to set this account up. It's not going to be just an expense account. It's going to go on the income statement, but I want it to be on the bottom so that it's like below everything else, because we don't typically sell fixed assets. So it's not part of our normal business operations. So we want this loss to be on the bottom. We're going to continue other. So it's an other expense and save and close. So that's one way we can basically set this up. Now this would work, and probably if you're comfortable with journal entries, you would go with this method, but it doesn't record the fixed assets. It just has a journal entry. It doesn't give us really the detail of the thing that we sold. Now we could give that in the memo. I could add a memo over here and say, like, copy this fixed asset item in the memo so I know exactly what was done, and that would probably work, just fine. But if I might want to use some system where I can connect this to the items. I have nothing linking to the items here. So possibly I could use some other system in QuickBooks to record it with items. And it might be a little bit more confusing to do that, but you got kind of that link that would happen. Again, if you just recorded the memo, you'd probably be okay. But let's go ahead and close this out and do it the other way. I'm going to not record this and say, well, like, I'd like to use one of these two forms that are typically used for selling inventory items or service items, but now I want to use it to sell this fixed asset item so I can use the items thing. So let's try to make a sales receipt, even though this is like not a normal kind of sales thing that we do. And then so I'm going to create a sales receipt, and I'm going to say the customer is the customer we're going to sell to, customer 1. Now this isn't a normal customer because again we're selling something that we don't typically sell, like an inventory. We're not selling inventory in this case. We're selling a property, plants, and equipment. We can choose the payment method. It's going to happen on 11/15, and then the item down here, instead of choosing like an inventory item like we normally would, we can pick up our item, which is this fixed asset item. So it's a fixed asset item of the conference table. That's the one we're going to sell. You can see it has this description on the right because I think that's the one we're selling, and we're selling that in the 700 pulls over. Why? Because when we went to the fixed asset list on this side, and if we double click on it, we said we sold it. We said we sold it, so it's lining up to that sales price we put here, that 700. So now it's pulling over that 700. If I go back into the sales receipt, it's a little deceiving, however, what it's going to do with that 700, because what you would like it to do, what we would hope that this thing would do, would be decreasing the fixed asset for the full cost of it, and then recording the 700 as basically the amount that was basically received, the amount that we sold it for. But that's not what it's doing. If you just keep it at the 700, what will actually happen is it's a sales receipt. That means that cash of some kind is going to go up. In this case, it's going to go into undeposited funds, which is like the default. Then we'd have to deposit it. So that's standard. The other side then And we could change that to the checking account if we want. But in any case, the undeposited funds goes up. The other side, if we just leave it this way, is going to go to a decrease to the fixed asset account for 700. And that's not what we want. We want the fixed asset to be decreasing by that 1347. So you could adjust this. I could say, okay, look, I need this to go down by the 1347. It's going to say, hey, that doesn't line up to the sales price, and I'm going to say that's true, but I want it to decrease the account by that amount. And then I'm going to basically just construct a journal entry so that this will affect what I want it to affect, right? So, and then I can use my item here. I'm not sure if this is adding a lot of value rather than just putting a really good memo in the situation if you're going to put it into a cash register or the journal entry that we talked about up top. But this is another way you can do it so that you can utilize basically the items section, so it kind of ties into an item when you see this. So then I'd have to say, okay, everything's going to run through the cash account, which is undeposited funds. So what's this going to do? Well, it's going to be increasing undeposited funds. The other side would be decreasing the fixed asset account of furniture and fixture. So that's correct. I'd like it to decrease the furniture and fixture. Then I also need to record the accumulated depreciation side of things, that 128. So what I'm going to do is I'm going to create another item. I'm going to select the drop down. I'm going to say I want a new item. And I'm going to make this I'm going to make it like the same description. I want it to be a fixed assets type of item. And so it's going to be a fixed asset item. And this is going to be I'll call it ACC Depre for the conference table and chairs. And so that's it. And then the cost, I'm going to see if I can make it a negative 128, which is the accumulated depreciation. It doesn't allow me to do in a negative, so I'm going to say 128, and then the date is going to be I'm going to say 02. Well, the date we sold this was 11/15/21, and then I would want to have the same description here: a GOF 6FT 10FT conference table, and so on and so forth with the conference table. And then the account that's going to be hit here is going to be the accumulated depreciation account this time. So we want the accumulated depreciation account, fixed asset accumulated depreciation. And then is it sold? I'm going to say it is sold. Sales description, date of the sale, I'm going to say is on that 11/15/11/15/21 sales price. I'm going to pick that 128 up again and see if it lets me do a negative. No, 128. So we'll keep that there. And so I'm going to say okay. And fixed must have a purchase description. So I'm going to say same thing on the purchase description and then save it. Fixed asset has been sold, must have a sales description. Okay. And then I'll ignore these items. Okay, so there we have it. And I'd like to put this in there as a negative 128. A negative 128. So what's that going to do? It's going to basically decrease the accumulated depreciation account. And the other side then should go to the undeposited funds again. And then lastly, I want to record the loss that we have. So I'll calculate the loss. So I'm going to say, all right, the loss then was, if I pull out the trusty calculator, I think that was it right there, but let's calculate it again. We have the book value of 1347. It's on the books minus the accumulated depreciation 128. That's this amount. We sold it for 700, so that's that 519. So I'm going to create one more item for the 519. I'm going to make this a normal kind of service item. So I'm going to say, let's make it a service item. And then I'm just going to call it sale or loss on furniture and fixture. And so that's I'll keep that the same. And that's going to be for, we can keep it blank here because I might need it in the future too. So I'll just keep it at that. And this is going to be hitting then our loss on sale of fixed asset account down here. So I'm going to pick up the loss, and we might want to make it more general, just say loss on sale of fixed assets. So that'll work for any fixed asset that we have in the future. I'm not going to set a rate for it. I'll just put the rate in place. So I'm going to say, okay, This item is associated with an expense. Do you want to continue? I'm going to continue. And so this is going to be then for that negative 519. Okay, and then we're left with the 700. So what's this going to do then? It's going to increase undeposited funds by the 700. It's going to decrease the furniture and fixture by the cost. Hopefully the 1347. It's going to decrease the accumulated depreciation by that 128. And it's going to record then the loss on the fixed assets of the 519. Let's check it out. Let's say save and close. And yes, and yes. And see what's going on here. So hold on a sec. It wants me to edit this thing. Let's try it again. I'm going to say, it wants me to change these. I'm going to say ignore, 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 ignore. And there we go. Okay, so now I'm going to go to the balance sheet and check this out. So if I then go to the furniture and fixture, if I double click on the furniture and fixture, we see now that the furniture and fixture was decreased by that 1347. The accumulated depreciation decreased and is back down to 0 for it. That's what we expect. That's good. Undeposited funds went up by the 700. That looks correct. Okay, so that's good. And then if I go to the profit and loss, then down here we have the loss on the sale of the fixed assets. That's good. And if I go into any of these items, then it'll go to that sales receipt, which could give us the more detail on it. So for example, if I was then to go up to the balance sheet and provide this to the tax preparer at the end of the year, and they wanted to take a look at the furniture and fixture, if I double click on this, notice it's opening up both of the activities because this is the parent account that I'm looking at. And they can then see the detail of this item that was sold. And in the memo, it gives you the description here. So here's the description of what's sold. And notice the accumulated depreciation is tied to it in the same line item here. So they have the description. They should then be able to find it easily on this page. And they should be able to tie it out then easily to our fixed asset item list over here. So now we have our fixed asset item list, which we can basically indicate the item that was sold on it. And again, I would do that with a report, running the report, sorting this thing out to indicate that the report will show that that item, that line item was then sold. So that'll give us that added kind of detail here. Now, if I line this up to what's left on this schedule, obviously this one was sold now. So really we're left with the 1126 plus the 753 after the point in sale, which is the 1879. And if I go back on over here, we're left with the 1879. So that makes sense over here. And we still need to record the depreciation for the rest of the assets. Now, again, I'm not sure that doing this recording the sales receipt this way to use the item is adding a whole lot more value than just doing a journal entry and putting in a good memo with it. But because I think the journal, for me, with debits and credit, the journal entry would be easier to do than kind of figuring this out. But you could do it that way, and you can use that. And then again, you can use the items function to basically do the sales receipt with that method.